Welcome to Strait Talk, Real Results, where we cut the fluff, break down the industry, and bring a little humor to a process that doesn't have to be so complicated. I'm your host, Lauren Strait with Lauren Strait Real Estate and Realty One Group. Hi, everyone. You're listening to Strait Talk, Real Results, the podcast where we cut the fluff, break down the industry, and still have time to laugh at ridiculously funny situations that this industry throws at all of us, buyers, sellers, agents, and our partners alike. I'm your host, Lauren Strait with Lauren Strait Real Estate, Realty One Group, and today is a great day because I get to host one of my favorite lenders in the industry, Chuck Biggs from Epiq Lending. Welcome, Chuck.
Well, thank you for having me, Lauren. And I did want to stop you for a moment. You said one of your, and I thought I was your only lender.
Oh, well.
But you know, that's hard.
Only lender. Okay. That is very true. So today I'm hoping we can get into all the fun stuff happening in mortgages right now and maybe even debunk that wild thing your cousin announced about interest rates over turkey dinner. I don't know. But before we start, Chuck, why don't you tell us a little bit about yourself and how you got into the mortgage business?
Well, let's see. I'm Chuck Biggs. I'm with Epiq Lending. I've been in lending, close to 30 years. So I'm dating myself.
Wow. So you started when you were 10?
Basically.
Okay.
Yeah, kind of right around there. And, so I started out really in the consumer finance field where we did some mortgages, a lot of consumer small loans.
Okay.
And that's where I kind of got my feet wet.
Okay, great. And so, what got you hooked? Was there a moment that you knew, this was your lane?
Well, I guess once I got into it and you started doing it, it became where this is the only thing I know. I guess I got to do this.
You got to do this, okay.
But I enjoy it. I love the camaraderie, the people you meet, the clients, etc. There's a lot of, nothing's ever the same, right? It's always, everything's different. Every situation's different.
And that's what I love. I know some people really like that routine, but I think that's what I love about this industry in general is that you do get to do something different and you get to meet people every day. So I totally feel you on that. And then what keeps you passionate about helping buyers in our community? Talk to me about that.
Well, it's, there's nothing, especially that first-time home buyer, when they get their first home, that smile on their face, that, it's one of the biggest purchases people ever make.
Right.
And when you forever own their first home, man, they're just beaming, right? It's like your 2-year-old birthday. It's the first one they kind of remember. You light the candles, their face lights up.
Yeah.
It's kind of that same scenario almost, and they're so excited, and it's really very fulfilling.
Yeah, being part of that journey is really amazing, and then hopefully they'll come back and you have them for life, which is really great. So, well, that is a perfect setup for us right now, and so I want to get into some real talk now. And so for those listening, I want to I'm gonna pepper in some funny get to know you questions. So, Chuck, tell me one fun fact or quirky skill that most people don't know about you.
Oh man. What quirky? Well,
that you can say on the mic.
Can I say online? Oh, well, see that. Shoot, well, that knocks about 5 of them out. But let's see. I don't know if I'd call it a skill. I do like to ride Harley Davidsons. That's
right. You are a motorcycle driver.
Yeah. So
I love that.
I don't usually wear this jacket, but I turn this in for a leather jacket, and then I'm off. Then I look like a different guy.
I love that. And if you weren't into mortgages, what completely different job do you think that you'd be doing it?
Well, when I was going to college at first, I thought maybe I'd like to get into psychology.
Okay.
So I thought about that, and that would have been totally different.
Right.
And then my dad discouraged me for that. He said, there's no money in it, and I don't want you on my bankroll my whole life.
Oh, that's so funny.
I said, all right, I better find another career.
I love it. So now that we know a little bit more about you, let's kind of dive into a little bit about what you do every day. And I thought we would do a little myth busting because there is so much noise going on right now in our world and our economy. And so I want to start with some big myths that buyers believe and that you and I see all the time. So question number 1, when someone comes to you and tells you that they're waiting to save 20% down before buying a home, what do you tell them?
Well, I let them know, say, hey, let's look at your situation. You don't necessarily need 20% down. There's many programs out there. So the 20% thought process has been around for so long, and yet you haven't had to put 20% down, even as long as I've been in the business.
Right.
And that's a long time. And but it goes back to where it used to be there was no mortgage insurance. And the whole reason mortgage insurance came into play was so that people could put less money down. Basically, the banks would be insured on the amount they lent over that 80% loan to value or allowing less than 20% down. And that's where it came about, where you could get people could buy with less money out of their pocket.
Okay.
So, and nowadays, you know, you can get in with as little as 3% out of your own pocket for a first-time home buyer. And then on top of that, there's down payment assistance that might cover all of that as well. So I've had people close. I have someone closing next week that's putting zero money down.
That's great.
Not just zero money down, zero money in closing costs.
Oh, wow. Is that a veteran or?
They are not a veteran.
Okay.
They are doing a USDA program.
Okay.
But the same thing could have happened with a VA loan. Exact same thing.
Okay.
So they're literally getting their earnest money, which for those that don't know, the money you kind of put in when you put a contract in,
right,
they're getting that back.
They're getting that back. Yeah, and earnest money is typically like 1% of the purchase price that you have to put down in good faith that you are willing to follow through on buying the home. And so they're getting that back.
We're returning it back.
That's
dollar for dollar.
great. That's great. See, this is why you need to be talking to a lender about all your options. So I love that. And perfect credit required. There's also a lot of talk in that realm too. So you need perfect credit to get a mortgage. True or false?
That is false. So most people don't have perfect credit, and there's different varieties of credit, right? You know, good to bad. But the reality is, you can get into a home with 3.5% down with a 580 FICO score. Okay, that's not perfect credit. All right, and I see all gamuts of that. And part of the process we try to do is not just, hey, you know, we're not. I've probably seen that advertisement, denied, right, and you get out. I really look at when I'm talking to people, say, hey, if we can't do it today, we're going to put a plan together so we can do it tomorrow.
Yes, I love that. So, because I've actually been in that situation, especially when we were buying our first house. You know, we had 2 1-year-olds, we had student loan debt, and so what our lender helped us do back then. I didn't know you back then, but I know you now. But that's what a good lender should be doing. Hey, let's work on this. Let's pay down. If you can commit to paying this credit card down, if you can get your student loan down, if there's anything you could do and take away from something else so that we could build that so that in 3 months you can buy a house, that's exactly what you should be doing.
And sometimes it takes even longer. I mean,
sure.
I've had a couple close this year. We started their process over a year ago.
A year ago, yeah.
And it really comes down to, and this is where it's why you want to work with a professional.
Yeah.
Is that it's not about me closing you today. It's about, can we get you into a home and give you a roadmap to get there?
Yeah.
Otherwise, I've heard many times where clients say, I know what I need to do. I know I need to fix my credit. Okay, but how? What are you working on?
Yeah.
Are you working on the right things?
Yeah.
Right? I want to put you, you know, you might want to go to Flagstaff this weekend, but if you've never been there, right, and you're not sure where it is, you know it's in Arizona somewhere. I'll get there, though. And you probably will. Right, you drive around enough, and someone will point you this and that.
Sure.
But I want to get you there in 2 hours, not in 2 days.
I love that.
Or a week, and that's the idea of what we try to do for you.
I think that's fabulous, and that's what you should be asking your lender too. Like, how can you help me? Okay, let's talk about the 2 big mortgage updates that just dropped in this week. So there's a couple of things that are going around. If you're thinking about buying a home in 2025, 2026. Talk to us first about what Fannie Mae is doing to eliminate that 620 minimum credit score. And I think, I'm not going to date her. I was going to talk about where we are today, but I don't know when this is going to air, so we won't talk about what day it is today. But effective November 16th is when that minimum credit score requirement was going to go away. Talk to me about what that means.
So the idea was they didn't want a carte blanche, or if that's the right word, of saying, you're approved at 620, you're denied at 619. So for a long time now, there's a automated engine that these agencies use. So Fannie Mae is one of the 2 agencies, Freddie Mac, Fannie Mae. And we put information in there, and when that information is put in there, it spits back, we can do this loan, we can't do this loan.
Right?
And so 620 was just one of the gauges that used to be in there. But I can tell you right now, and I don't know yet, we haven't seen how it's going to exactly work. Have they tweaked other things? But if you were going to buy a house with a conventional loan, now you could 620 FHA all day long. On conventional, in most cases, it's going to deny it.
Okay.
If you're putting the minimum down. If you
Okay.
were putting 20% down, 25% down, it probably approves it. Okay. So there's a lot of information that weighs out. Do you have a lot of assets, et cetera? It makes up for things. If 620 is the only, then I don't see it changing much, to be honest with
Sure.
you. Except that, say you do have 50, you got a 610 credit score, and you're putting 50% down, you'd be denied 100%. Doesn't matter. Doesn't matter that you, which doesn't make sense either. Really doesn't make sense.
So
I
now
got
they're,
$1 million
now they're
in the bank.
changing those rules. Essentially, is that what's
Basically,
happening?
they're just not they're not going to allow that to stop the deal.
Okay.
So
They'll
if
look at
everything
the
else-
whole picture.
They'll look at the whole picture.
Which is
So
great.
if the whole picture makes sense, and it makes sense if someone's putting a bunch of money down and their credit's kind of but they've got money in the bank, then they got skin in the game.
Sure.
Right? The bank's going to take that risk now. Now they'll be able to because the agencies will buy that loan.
Yeah,
Where
it's
before,
not just an
If it
automated.
was 619,
You're denied.
it's an automatic denial, and they would not buy that loan. So everything could look perfect.
So that's good. That's good that they're finally like looking at
Yeah.
the whole thing. It's like,
It's
okay,
more
I
common sense.
I might
would
have a
say.
619, but I own 3 homes. I have all this money in the bank.
Yeah.
I know I haven't missed
I'm
a
putting
payment.
20% down.
I'm gonna So they look at the whole picture. I love that. Okay, dare I ask you this question about so we're obviously doing brainstorming at the federal level of how do we get more people into homes and become homeowners? You know, we've seen our generations kind of change mindsets about that, and one of those brainstorm ideas was talking about maybe putting a 50-year mortgage option on the table. So talk to me about that.
Well, so you're using a great word, brainstorm, and that's really what it was. That's really ideas, and what we used to say is we'd get us all in a room and we wanted to talk about, hey, how can we make something better here? There was no bad idea, right?
Sure.
It may not be what we'd want to do in the end. We may say, hey, that's not a good idea. But it's not a bad idea with the concept, right? Because how do you have discussion if you don't think of something different? That's really where it's at now. Will this ever happen? We don't know.
Yeah.
What I try and do on something like that, because boy, there's a lot of opinions online, right?
Of course.
Negative.
Everybody
mostly
has an
negative.
opinion, right?
Yeah.
What do they say? Opinions are like, no, I won't say
yes,
the
you
word.
want-
Opinions are like something, and everybody has one.
everyone has one.
Anyway.
Yes. And so in this case, when I look at this, I say, hey, I try not to be so opinionated that it's going to be, if it's not going to work for me, I'm not going to let it work for you.
Sure.
Right. So like anything, it's going to have some positive and some negatives. Obviously, the main negative people talk about is, well, because you're paying less, you're having less principal reduction. So in 10 years, you're going to owe more than what you would if you had a 30-year mortgage.
Sure.
Exactly. But you know what? I could say the exact same thing about a 15-year mortgage and a 30. Well, then why would I take a 30-year mortgage? Because if I did a 15-year, I'm going to have a lot more principal reduction in 10 years. In fact, I'll almost have it paid off, where on a 30-year, I'm just starting to make some really good headway.
Right.
So I don't think you can apply that principle to it, because then, we can just keep going down the line. All right, well, we should pay cash. Then I don't pay any interest.
Yeah.
Yeah, but how many people can pay cash, right?
Right.
How many people can afford a 15-year mortgage? So the idea of the 50-year is it's going to lower that payment, and, some say it's not enough, but, on a 400, I ran some numbers.
Yeah,
and I
bring some
believe,
numbers.
On a $600,000 purchase price, if you were putting, I think we put 15% down, we were using for an example.
Okay.
So you had a $510,000 loan.
Yeah.
So at a 6.5% interest rate, you'd have basically, after 120 payments, you would owe, just to give you some numbers here, your balance would be $436,000.
Okay.
On a 30-year.
On a 30-year. Okay.
Everything else remaining the same, 6.5%, 510 loan amount in 10 years. On a 50-year, your balance is going to be $490. Okay.
Wow,
So
yeah.
what is that? So that's about, it's substantial. 60,000? Not quite. 50.
Yeah.
Around 50.
Math's not my
Something
strong suit. So.
Would be the difference. But no one says that you have to make that minimum payment. So I'm
True.
a first-time home buyer.
That's what I like. Yeah.
Or maybe I started a new job. Hey, I know my job's going to be great. I know I'm going to have raises coming, but I'm an entry-level position. I can't afford a house now. Pay out a 30-year. But that $350 less payment, I'm in. I can get in.
Right.
I'm going to pay that much nearly in rent. So why not
Just
go in?
and
I know
own
in
it.
2 years, I can either refinance it if rates drop.
Yep.
But if they haven't, I'm not locked into that payment.
Right.
I can pull a financial calculator out, and it'll tell me what payment I need to do to pay it off in 30 years, 20 years, 15 years. I can pay more when I can. But it got me in, and guess what? If the house goes up 4%, that's what normal, right?
Like equity.
Over time.
Yeah.
So if I waited 2 years to where I could get that 30-year mortgage, and now I'm paying 4%, well, what is that on a $600,000 house? That's what, $24,000?
Don't ask
Something
me.
like that?
You'll know better than me.
If I'm paying that much more for the house now,
mm-hmm.
I didn't save any money by waiting. Right?
Yeah.
So I think every situation will be different.
It will be different. 100%.
It will be the right loan for everybody? Of course not.
Sure.
But to say carte blanche, nobody should have it, it's not responsible, we don't want to allow anybody to have it, I don't think that's right either.
Sure.
I think people should have the right to make choices for themselves because
sure.
everybody's situation is different, and used wisely,
mm-hmm.
It could be a great tool.
And I love that you mentioned, because what people don't understand, like, we're not taught to pay more. It's always like minimum payment is this, minimum. We're advertised from being a little person to only pay the minimum. And I think, to your point, that is a great option. If you got a 50-year loan, your entry-level position, there's room to grow. In 5 years you're going to be in a different spot. So then you start paying, $350 more a month in 3 years, 5 years. I mean, even my husband and I did the math. It was like, if we paid an extra $100 a month now, we could pay our mortgage off in 10 years less.
Yeah, just a little bit extra.
So think about that, guys, when you're thinking about all that. So that's a
so don't
good
listen
point.
to all the noise.
There is a lot of noise.
And then when you have your discussion, make sure it's someone with open-minded to allow you to make the choice, right?
Yeah.
Don't allow me to make the choice for you.
Yeah.
I will give you...
And put the math on paper with your lender. I mean, that's really important. So, okay, next. So other questions. So I also asked ChatGPT, because that's what we're doing these days. What are buyers literally typing into Google right now? And here are some of the answers that I got, and I wanted you to kind of maybe help us with these. So the biggest one, actually guess, what's the biggest one that they're asking on Google? Can you guess?
Good question. What is the biggest? Well,
the answer. Yes. When's the interest rate going to go down? So this is everyone. What are buyers hoping for, and what is the realistic outlook? Now, I will say we are in Q4 of 2025. I can date that in relation to the podcast and when this will come out. So let's look at 2026. What is that realistic outlook from your perspective?
Well, so I did some research on that before I figured this was going to come up.
Yep.
And of course, it comes up every day almost with clients.
Absolutely.
And the industry has been predicting big rates dropping over the last few years.
Yep.
And I guess it really hasn't happened.
It hasn't happened.
Now we've had a little improvement this year, and it's likely to continue, but I tell you, it's not going to be this big windfall. So if people are waiting, for rates to drop into the 4s and 5s, good luck. You probably need to reanalyze your plan.
Yep.
Okay? Because here's some of I'll just read you some numbers here.
Yeah. We'll put graphics up.
So, for example, by the end of one big analyst is saying by the end of the year, end of 2026, we're looking at maybe down to 6.1 for a 30-year fix, 6.1%. Okay?
Wow. Okay.
Well, what are we now? 6.5,
6.19, or
depends.
I don't know.
It's
on what
gone up a
at.
little bit over the last week. So, but that's not a huge difference. There is another group that's saying maybe high 5s, but that likelihood is a lower percentage of people that think it's going to go that low. So the best case scenario would be slightly below 6.
Sure.
More likely,
Yeah.
mid-6 range.
Yeah.
Market steady, some segments strong, others weaker. That's kind of the projection. And the less likely is that rates climb over 7%. They don't think that's going to happen either.
We're looking at this 5, 6 is like, if you're expecting a 3 or 4% mortgage rate, I don't know if that will ever happen again. And let me tell you something. Yeah. I did some math. Okay. All right, guys. Don't kill me. But equity in the homes, especially in Arizona, the valuations are increasing year over year, higher than most any state in the USA. So, for example, last year in the $1 million range in Cave Creek alone, because I tend to work out of Cave Creek, 35% increase on average that home values went up. So it really doesn't matter if you're going to wait, because if you're going to wait and your interest rate goes down, you may save money in terms of maybe $30 to $80 a month, but you're paying for a much more expensive home. So the valuations are continuing to climb. So keep that in mind. Like, is it worth renting for 5 more years and then paying for a much higher valuation home that you were looking at 5 years ago because you wanted the rate to go down an extra point? I don't know, guys. I'm telling you, it might not be
the real dollars. You might have a lower rate, but the real dollars in interest you're going to pay is going to be more more.
And you could have got 5 years of equity instead. So, anyway, that's kind of, and again, we'll run some numbers here on the screens for you guys too, so you can get a better idea. So, all right. Let's look at market conditions. So how do you help buyers balance waiting, since we're talking about that, versus buying a home right now? So we kind of went over that a little bit about the spiel. Yeah.
But it's kind of back to that though. Why are they waiting?
Why are they waiting?
Question. Why do you want to wait? Well, there's a variety of reasons why people may be waiting, but a lot of times it is, I want to wait for rates to drop. And I think this is where
their parents are telling them that. Yeah. Their uncles are telling them that. Their cousins, sisters, mothers are telling them that. So that's not always the best thing to do.
Yeah.
Sorry.
And these are people that all own their own home, right?
Correct.
So it's easy for them to tell you to wait while they gain equity in their home.
Right.
But what you really need to analyze is to sit down and say, all right, I'm paying in rent now, right? Unless you're still living at mom and dad's. But if you're not and you pay rent, then you can look at, well, wait a minute, if I'm paying rent, if I could buy a home for something similar or a little bit more, if I know values are going to work their way up, and we know even overall 3 to 4% is being very conservative that you're going to gain every year on average, okay? And we know we have years, especially in Arizona, where we get a lot more than that.
Absolutely.
I mean, people that bought in 2019 have hundreds of thousands of dollars, even on I'm not talking about $1 million house.
No, $500,000 house. They
have
$700,000-800,000.
Yeah. If they've gained in equity, would they been able to save that over the last 6 years? I think not, right?
No.
That's probably not going to happen. So what you want to do is really, like, if rates really aren't going to be dropping that much, like I said, Fannie Mae says 5.9. Mortgage Bankers Association says 6.4.
Right.
Trading Economics says 6.3. Okay? So we can see where that window is. So best case scenario, we get maybe below 6%. You know how much that is in payment, folks? That's not much.
Not much.
Okay? That's not much. The difference between on a $600,000 house, 5.9, 6 and a quarter. It's it's a couple coffees a week,
couple Starbucks.
Yeah.
Yep.
I mean, it's not that much money different.
And we know you guys are all, I'm a Starbucks on Fridays girl, so we all know you guys are doing that.
Happens, right?
You know what happens. That adds up. It's not $5 anymore.
So they're just not magically going to fall, right? They're just not. So if that's what you're thinking, you need to reassess that process and say, all right, if this is the new norm, which it most likely is, then how do I move forward?
Yeah,
right?
and let us help you get there, really. I mean, let us help you.
And let's say rates plunge. Some miracle does happen and they plunge.
Yeah, even better.
House prices are going to skyrocket, and guess what? You already own your home. It's very easy to refinance.
Absolutely. So I love that, because you did that for me, actually. We bought a second home in November 23. It was the highest interest rates that anyone's seen. I think we had... It was an 8.5 or something ridiculous.
It was 8 point something. 8.125 maybe.
Woo! Yeah. No, I know.
And that was me giving her a deal.
Yeah, he gave me a deal. No, I'm just kidding. No, he really did. It was really the best thing we could do, and I will say we went ahead and did it because 18 months later, rates for a second home went down. Obviously, rates for a second home are always going to be a little higher than your conventional or your FHA. I was able to refinance, and during that refinance, we had to get an appraisal done. Yep. In 18 months, we gained $85,000 in equity. So, we paid a little more, for that first 18 months with our interest rate, but I'm telling you, it was the best thing we could have ever done. I'm so glad.
Yeah, because what would that return be? If you gain $35,000 divided, what is that, 20%? What is that?
I don't know.
But whatever the return is, we know it's more than 8.12%.
100%.
So anybody, if I'll give you $8 if you give me 20 back, right?
Right.
Everybody will do that.
Yeah.
So,
and we get to go enjoy the pines and get out of the heat in the summer and play in the snow in the winter. And, we did it when our kids were still at home. And so, we took a little bit of a risk, but honestly, it was worth it. It was so worth it. So I'm glad we did that. So anyway, I wanted to make sure and point that out. All right. I know this isn't your favorite topic, but I do want to go over it because there is another type of way to buy a house these days, and a lot of people are getting in on the know of this, and myself included. I am Assumable Loan. Let me say it again. I am Assumable Loan Certified, which means I can help people find homes that you can take over their existing loan, especially if their loans are lower than market value. It would be a benefit to you. So I know that kind of takes a little bit of business away from you, potentially, but could you explain what an assumable loan is and how that works?
Yeah, so assumable loan basically is I want to buy your house, Lauren, and Lauren, you have a type of loan that is assumable.
Mm-hmm.
It allows me to take over your loan. So when does that take place, or what loan options are there for
right.
that? Well, the reality is there's not a lot of assumable loans anymore, but there are 3 specific, and they're basically government loans.
Correct.
VA, FHA,
yep,
and USDA. Okay. Now, here in the Valley, USDA doesn't come up too often because it's basically a rural lending program by the government, and we're not very rural anymore.
Right.
But you get in the outskirts of town, or not even outskirts of town, but you get down, Rio Rico,
sure,
maybe north of Wickenburg. There are areas that USDA is still there. So, back to the assumable. They're all different, okay? USDA actually probably is the hardest one to qualify to assume. Okay, for assuming anyway, has a little more restrictions. So want to start with VA?
Yeah, so tell us who can assume a VA loan, because people are like, oh, a VA loan, a veteran has to take over a VA loan, and actually that's not true.
No, so anybody can assume a VA loan. You don't have to be a veteran, okay? Now, there are some risks there to the seller. So if your sellers out there that are listening to this, well, gee, I got this, 2.5%. That'd be really
VA
attractive.
loan, yep.
So one thing, and I'll step back, and this would encompass all of these assumable loans, is what people need to remember is you're assuming whatever that balance is at that moment, that payment, that interest rate, that payment.
Correct. So let's just say 30-year loan, they've had it for 5 years, so now they've paid down 5 years worth of their principal, but you also have to include the fact that there's a new valuation on the home, so that whatever equity they are looking to get out of that, you have to come to the table with. So if it's a $500,000 home, they've paid $200,000 on it over 5 years, and it's a 3.5%, you could take over the 25-year loan at 2.5%. You have to come to close with whatever they want you to sell the house for. So I'm assuming it would be more than $200,000. So let's just say now the home is worth $600,000. So you have to come to the table with $300,000 at close in order to assume that loan.
Yes. So you're going to have to come up either out of pocket, and a lot of times with the types of loans we're talking about, people that get these loans don't have a lot of money out of pocket, right? Typically.
Right.
So where are you going to come up? Now, you can get a second mortgage sometimes. The seller could carry it back. But figure in any of those situations, unless the seller's going to carry back 100%, which is not going to happen in this market, not often anyway, you're going to have to at least come up with 10% out of your pocket. So you're going to need at least 10% of your money, even if you get a second mortgage, because most second mortgages will only go to 90. And then you got to weigh out, all right, I have a 3.5% first, but if I have an 8.5% second, what's the real interest rate I'm paying?
Sure.
As a lender could guide you on that and say, hey, this is what your real rate is. Well, I'm not ahead, right?
Yeah.
Maybe you will be, maybe you won't, but you need to weigh that out. If you're a seller, there's some other things. As a seller, you want to make sure you get a release of liability.
100%.
Okay.
Yeah.
What that means is, hey, if that person doesn't pay that assumes your loan, you aren't personally responsible for it. Because if you don't get that, you are personally responsible.
You are responsible. So you'd have to look at that as well. 100%.
So you want to request it because they don't always issue that. Okay, you're going to ask for it. make sure they'll approve it for that. Another thing on a VA loan, what you need to keep in mind is if you're the seller, is the eligibility. So as a veteran, you have you have VA eligibility, which tells you how much of a loan you can get. So if you want to sell this home and buy another one, use your benefit, you have to realize that unless it is a veteran who's buying it from you and they now switch to their eligibility for yours, your eligibility is being used. Okay, so you may or may not be able to qualify for another VA loan on your next home.
Right.
So it's really important to really analyze that. Is that worth it to you? Okay.
Yeah, and then there's certain ones too, like VA or FHA. Some of them they have to be your primary resident. They can't be. I can't remember which one is which, but you have to move there if you're gonna take over that loan.
Yes.
There's only one kind of loan that if you want it to be a rental property or an investment property, I think that's FHA that you can do that with, but not VA.
Yeah, VA for sure has to be your primary home because those are
VA for sure has to be your primary home.
And on FHA, I don't want to speak out of turn.
I think you can assume it as an investment or a primary.
And I had some notes I did take on it, but
that's okay.
That's something that you want to dig in further. What you got to keep in mind too is how long does it take?
Yeah,
so
it takes. Go ahead.
Yeah. And a lot of people think, the VA takes so long to approve them. It's not the VA. What it is that these loans are being serviced, right?
Yes.
And the servicer is making very little. Might be a little bit of a fee for it, but very little on it.
Yeah.
So how many resources are they allocating to process loan assumptions?
Yeah. And they can take up to 90 days. Yeah. So if you want more information on assumable loans, please give me a call because I actually have a platform where you can tell me, I only have $100,000 that I can put down. This is the payment I want to make per month. This is the kind of home that I'm looking for. I either wanted a primary or a secondary, and I can actually use those variables in the platform that I have access to be able to find you those types of homes. So I can definitely get you more information on that. So
and
I know that's tough.
Keep in mind on FHA too, you definitely have to be approved as well. You have to be approved. Your income, all of that. So they're going to approve you. They're going to income approve you. So it's just, you just don't sign. There used to be back in the day. Now there are actually some FHA loans still around, believe it or not. Not many. That it was no credit pulled. Anybody could assume them. But I believe that goes clear back to like 1982 or something like that. It's a long time. There's not many of those left. And I can't imagine the balance would be much. So I don't know what you'd be assuming. $10? I don't know, something like that. Yeah. And then you're having to pay $900,000 cash. I got a $900,000 second and a $10 first.
Right.
So I got 2% interest rate on my first.
And on $10.
10% rate on my second. So.
That's funny. Well, speaking of approved, so this is the last part of our little segment today. Chuck, thanks so much for being here. I always enjoy hanging out with you. I want to play a little game. So I'm going to give you some totally real, absolutely ridiculous buyer scenarios. And I want you to tell me, and these are based on real scenarios that maybe you or I or someone else has encountered. And I want you to tell me if they would be approved or not approved. So, are you ready?
I'm ready. I think.
All right. So
maybe I should have some of your wine you have.
Some wine. Yeah, no, it's water, I promise. All right. So scenario number 1. So somebody has a 720 credit score, a steady job, and modest student loans, and they want to put $10,000 down. Approved or not approved? I know that
would probably be approved.
Most likely. Okay. Most likely approved. Obviously, there's going to be other factors.
There's other factors.
Yeah. Okay, so how about scenario 2? 800 credit score, but they changed jobs 2 weeks ago. Approved or not approved?
Okay, so again, potentially approved, potentially not approved.
Okay.
So if they just graduated from college and they were working at Denny's and now they got their doctor's degree, now they're working at the hospital, that's going to be approved probably all day long, if those student loans aren't too high. But we have doctor's programs for that.
There you go.
So a lot of times people think this is a good example for if you went to school, and it doesn't necessarily mean you went to college. Let's say you went to a skill and became an electrician. Okay, you just got your certificate.
Mm-hmm.
I don't need 2 years of history. on that, right? You now have a skill, and you can prove to us that you got your either degree or certificate, and prove this. Give us your school records. We can use that income now, even though you may have been making substantially less just 2 months ago, but because you are doing the work in the field that you went to school for.
Yeah. Okay, I love that. Okay. Good to know.
So you thought I was going to say no.
I know, I did. I was like,
I never say no.
Yeah. Okay. Scenario number 3. So found a 1% down program, no savings, opened 4 credit cards last month, approved or not approved?
Okay, I was not listening, so you're going to just read that again.
He says he never says no, guys. Listen to this one. Okay. Somebody found a 1% down program. They have no savings. They opened 4 new credit cards last month, and now they're ready to buy. Approved or not approved?
Well, it sounds risky. But, again, you'd have to know all the parameters. Do they have, if their income is good, there are 1% down programs, really an FHA program with some type of grant money in most cases.
Yeah.
So it could be approved. It doesn't sound like a winning proposition.
Sure.
But
maybe. Okay.
But not, I would advise you not to do that if you're asking me that question.
Okay. All right. And last one. So someone lives with their parents. They have no rental history, perfect credit, $7,000 worth of gaming equipment and subscriptions. Approved or not approved?
Boy. Well, again, could be approved. I'm not sure what the gaming equipment will do for him. I guess he could sell it for down payment as long as he got receipts.
Okay.
You don't have to have rental history to buy a house. It helps. But nowadays, we see a lot of people buying their first home and they're moving from mom and dad since they live there a little longer these days.
Well, on that topic, should the mom and dad, could they charge rent and provide receipts? Would that help a buyer?
Yeah, it would, because rent is looked at as a positive. So if you can show a year of rent, the only problem is...
You hear that, Owen and Landon? Yeah. You're 18 in February, just so you know.
Yeah, there you go. But if you do that, and it's mom and dad, because it's mom and dad, you're going to have to prove that it's real. So you want to find that thing your parents have that you may not have, a checkbook or something, or draw it out of your account electronically so it goes to them.
Okay.
Just so that there's a paper trail
history.
And you have 12 months of history.
Okay, 12 months.
Then it looks legit, right? Because if you don't do it that way, and it can't be, if mom's the cosigner in your checking account, it's not going to work.
Okay.
It needs to be your own account, and you're paying them rent.
Okay. So if they have a student account, when they turn 18, they need to get their own big boys account.
Get their big boy account.
Okay. That's good to know. All right. Well, hey, that wraps up today's episode. Chuck, thank you so much for breaking down everything from myth busting to assumables and even our approved, not approved game. So where can listeners reach you if they want more info about getting pre-approved or learning about loan options?
Well, you can always call you, and Lauren can send you to me.
True.
Or you can call me direct, and I'll send you to Lauren.
Okay.
But I can be reached at 480-258-2281. That's my, obviously my phone number. You can also look me up online if you like. Chuck Biggs at Epiq Lending. I've got websites and et cetera on there, and we'll probably flash it right up on the screen.
We'll do that. We'll absolutely do
that. And reach out to me either way. But I always tell people, you don't have to be ready to buy or think you're not ready. Call, plan.
Start the conversation.
Yeah, start
absolutely.
the conversation.
I love that.
Put the plan in place, and together we'll make it happen for you.
Love it. And to our listeners, thank you for joining us today. If you've enjoyed this episode, please share it with someone who's house hunting or mortgage curious. You can follow us on YouTube at Lauren Strait Real Estate. Hit the subscribe button and share with your friends. Until next time, Strait Talk, Real Results, signing off.